And welcome to the Mutual Fund Show. I'm your host, Niraj Shah. And remember, we're talking about what's happening in the banking in the PSU debt categories. Mirae Asset Management has decided to come out with a fund, a new fund offer, which is the Mirae Asset Banking and PSU Debt Fund. Remember, these are funds which invest in debt and money market instruments issued by banks, PSUs, and PFIs. Let's get in the Mirae team to talk about the rationale for a fund in the current times. We'll also have Sunil Jhaveri. Um, he's been with us on the show a number of times, Mr. Bond, as he likes to call himself, to talk about his thoughts on this offering as well as on this category as well. Gentlemen, all of you, thank you so much for taking the time out and speaking to us. Swarup Mohanty, Mahendra, Jajoo, Sunil Jhaveri. Swarup, good afternoon. Let's start off with you. What's your sense? I mean, why the timing of this fund at the current point of time?
Yes, thank you for having us on the show. I don't think it's all got to do with anything with the timing. See, we get an approval, we launch a fund. And then when you look at the journey of the fund, the quicker we start it, the NAV comes out faster. See, our business is to launch funds and build strong track records. So the timing is immaterial. I mean, it's in the long run that the story of a fund really unfolds, and we'd like to concentrate on that part. Yes, the bank and PSU fund definitely from our side will be a very important launch from our side, because we signal our presence in the longer side of the debt business, and we've had a good run with the dynamic bond fund so far. So we built some credentials to that, and thanks to Mr. Jajoo for steering that as well. And now we launch into a category which we believe matches the risk profile of the Indian investor. It's a great category to be in, and we'll start our journey as soon as possible. We end the NFO on 20th, and after 5 days the NAV starts, and our story too starts in this category.
Mr. Jajoo, you want to add to this as well? Agree. I was not saying that this has been done in a particular fashion to time the markets, but it's an interesting time at which this fund is coming out, right? With all that's happened in the last few days, weeks, months, years, maybe 2 years ago, we had the first SL issue coming out. 2 months ago, we had the Franklin issue coming out. So the timing is interesting in that sense.
Well, as Swarup sir said, that the timing for a long-term investor isn't a relevant factor. But yes, because of the series of defaults that we have seen in the last 1.5 years, the banking and PSU has become a very popular category because of the flight to safety. And because in this category, the investments are primarily in the banking and PSU papers, which are, because of the government and the RBI oversight and ownership, are considered safe. This has become very popular. In our fund, as per SEBI guideline, minimum of an 80% has to be invested in the banking and PSU papers. But just to maximize the safety from a credit perspective, what we are proposing is that in our fund, even within that 20% flexibility that the fund manager has, they will only invest in the banking and PSU category papers, or maybe we will invest in the government bonds. So this fund will therefore provide the maximum possible highest credit rating that is possible to be created in the current market environment. So it will be a very safe category. It happens to be a very well-timed entry, although we haven't planned it that way. It's just that we got the approval and we need to launch it now.
What kind of returns can an investor expect, Mr. Jajoo, if he is investing into this category? I mean, just generally, just trying to guess, because people would want to know, right? What is it I'm getting vis-a-vis other products?
Yeah, so that is always a dilemma for us as fund managers, because SEBI doesn't allow us to talk about the returns. But at a general level, if you look at the long-term history of the debt funds, they have given somewhere between 7.5% to 8.5% on an average. And I don't think that that pattern will change, because we have seen different cycles on the interest rates, and we have done some analysis where we took the start date as 16th October 2003, which happens to be the day when our 10-year benchmark government bond yield was at a life low. And from there to the next 17 years as of today, a typical bond fund has given a return of something around 8%, give or take a few basis points. So I think the fact that a lot of people think that the interest rates might have already bottomed out after the Reserve Bank's aggressive action over the last 3 months, or generally over the last 1.5 years, I think that the interest rates are cyclical in nature, and therefore the way to go about the interest rates is to have a flexible interest rate management policy, where if the interest rate
Right.
environment changes tomorrow and the interest rates go up, then you bring down the duration and so on. So I think independent of where we are today in terms of the interest rate cycle, I think the historical pattern is what one should expect to be repeated even over the next 3 to 5 years.
Okay. Before Swarup reverts with one more thought, let me get in Sunil Jhaveri in this conversation as well. Sunil, of course, always good having you when it comes to these conversations. What's your sense about this particular category? We'll talk about this fund later on, but this particular category in the current scenario. And please, Sunil, it's okay to differ with the other two guests who are launching this fund. It's great to have differing opinions. Um, Sunil, maybe you're on mute because you can't. Sunil, can you repeat because we couldn't hear the first part of your answer?
Okay, so I'm in totally in sync with Mahendra and Swarup for this particular category of debt fund, and timing is, according to me, an extremely crucial part of this debt fund also. Though they may not have timed it as Swarup rightly said, the timing is important because right now the overnight fund, the ultra short-term bond fund, etc., are generating 2.5-3% returns. So nobody wishes to go there. The credit risk space, it's a recent history where nobody wants to be there. Corporate bond funds will have some kind of doubly rated paper. So again, there is a question mark there. So the nomenclature and the sheer credit space of this particular scheme is ideal at the current situation, where I expect that there will be a lot of money flowing into the debt markets now, with the equity markets having become extremely expensive once more within a span of 4 months from 23rd March to currently where we are. Though everybody knows it's a liquidity-driven market, but at some point in time, as and when the corrections happen, people will again rush back towards the debt category, and this will be a category which can capture that flows also. So from timing perspective, from credit risk perspective, from liquidity perspective, all three perspectives, I think this is a very ideal solution which Mira is bringing on the table.
Swarup, what kind of investors are you targeting out here? Because again, I mean, as strange as it is, it's very difficult to launch an innovative product in the category that we have, right? So there would be other such products out there available too. What kind of investors should target your product, and what are the risks, Swarup, according to you? Because we live, as we like to say, in uncertain times currently.
I completely agree with the question. Is that, first of all, the category is, I would look for suitable for investors who invest for 3 years and above. That's the taxation law of India anyway. So people who are, if Mr. Jajoo or Sunil can differ with me. But the fact remains that investors across categories, and we've seen in interest from the retail to HNI to institutions in this category. And the fact remains that the category was just a 40,000 crore category 1 year back, is now almost a lakh of crores. So that shows the interest of people in this category. The comforting factor which I like about this entire category is the risk profile, as Mr. Jhaveri rightly pointed out. It's a well-balanced risk profile, though one must look out for the 20% of non-bank and PSU, and that's where I'd like Mr. Jajoo to reflect on the portfolio strategy. But from coming to your question, yes, it's a risk mitigated category from the Indian debt investors' perspective, and investors who have the appetite or the horizon for investments above 3 years are suitable for this category. My only submission before I hand it over to the other speakers is that when you look at investing in debt, unlike equity, the allocation is yet to unfold. I mean, there is a reason that every category is different from a risk profile perspective. I would sincerely request all investors to categorize the different categories in debt also as per the risk profile and invest accordingly. And that till now data says has not happened. Debt sales mostly happens in trends, and we've seen suddenly the corporate bond fund and the gilt fund and the bank and PSU being in vogue. I think some amount of differentiation of the risk profiles of each category should be put in place and allocation made accordingly.
Here's, I did a show with Swarup where both of us were panelists, and the last question on this show, I'll ask Swarup about this, is to what would you say to people who get these emails from banks saying that you keep your money safe and keep it in fixed deposit and X% return? Could funds like these be options? But at that question, I'll ask Swarup at the fag end of the show. Before that, Mr. Jajoo, Swarup mentioned about you detailing out the strategy. I think you briefly alluded to what the other 20% could also have, but can you elaborate a bit on that? Would you veer towards super safety, or would you towards taking some bit of risk in order to try and maximize return in that 20%?
See, when the investors are looking at debt funds, and especially when they're looking at the banking and PSU category, their primary objective is the safety. And there is no compromise. As I said, that we would try to provide the maximum possible rating and the safety in terms of the credit. So therefore, we will, even out of that 20% flexibility that the SEBI guidelines provide, stick to the highest quality papers in the banking PSU and the government bond space. Now, as far as the returns are concerned, as we have shown with our dynamic bond fund, there is this misconception that the credit can yield you a little bit higher return. We believe our core value system or thought process is that market risk is temporary and credit risk is permanent. So if you happen to meet with one credit accident, and that we have seen in the last couple of years, then it can upset all your return calculations, because essentially at the core of the money lending is that your money should come back on time. Otherwise, all your return calculations are invalidated. We would rather accept a bit of volatility because of the interest rates going up and down, because if one has adequate investment horizon and with a little bit of patience with volatility, then at the end of it is likely to come out with a decent outcome. So I think the return is not a concern with us. The prime objective is to avoid credit situations. And as we have seen in case of the dynamic bond fund that we launched a year back, the returns have been pretty okay, because there is so much volatility in the interest rates. And I mentioned about our flexible investment strategy. So it's all about being able to manage the interest rate risk. The returns will come. That's what we believe. And I think there is enough talk now that the gilt funds or the bond funds have given such a fantastic return, whereas the credit risk funds have had their own difficult time in the last couple of years. So the investors need not worry about the return as long as they are okay with a bit of volatility on account of the interest rates moving up and down.
Okay. Sunil, can I bring you in this conversation on whether this is a good time for what kind of investor to invest in such a fund, not just in the Mire NFO, but funds in this category? Because I remember about 2 or 3 months ago, you said that you are moving out from parking money into debt funds and moving into parking money into equity funds. So what's your sense now?
We are out of equity again, once again, because as I said, in a span of 2 months from
short term, Sunil.
Pardon?
That's short term, and mutual funds are for the long term.
I can't help it. It's a valuation game, as I've been saying, that based on the valuation, we do this in and out. But ideally, what I would like to position this category is that, when you're investing in your portfolio, there is something what we call asset allocation. Let this be a core portfolio under that asset allocation in the debt segment. The unfortunate part is investors think that only money can be made only out of equity as an asset class, but they forget that consolidation phases. There are many consolidation phases which happened in India also. 92 to 2002, equities delivered 0% or 2% return. In gold from 1990 to 15 years thereafter, there was absolutely no return. Something similar in US markets from 2000 onwards till 2012. So during these consolidation phases, if you are not being right in your asset allocation, which includes debt as a category, then you will tend to lose out and you will not tend to make returns on an ongoing basis. So ideally, the asset allocation strategy, make this your core portfolio, so you don't have to bother about your credit space, you don't have to bother about your liquidity space, and let the fund manager find the sweet spots, which Mahendra will do a fantastic job, I'm sure of that. Between 2 years to 5 years is what they are going to do. And based on that, they will deliver returns, because it's not a question of just one cycle or 2 cycles. Let this be a multi-cycle investment. And we've done a show with you, think debt, think long-term.
Think long-term, sure.
Yeah, and that's exactly what I would tell the audience also right now. Invest
Okay.
in this, forget about it.
Okay, we have about 2 minutes, so I'll give 1 minute each. So 1 minute, Sunil, to you first, very quickly. What other options aside of this NFO? I'm presuming that from what you're saying, that you are saying that people can subscribe to this, and please correct me if I'm wrong. What other options aside of this NFO in the same category?
In the debt category, I don't see many options available right now. If you have the appetite for credit space, go to the credit space. It has a lot of opportunities there, by the way. But having burnt fingers, I would not recommend for those who don't understand credit to go there at all. Liquid fund and the ultra short term, as I said, is giving you sub fixed deposit returns. So why would you go there? This category, and there are different types of investment strategy. One of the schemes has a 10-year roll down strategy. Here, Mahendra is going to be managing dynamically between 2 to 5 years and so on and so forth. So this category, according to me, is
Right.
I think a category which will stay for a long period of time now.
Okay, Swarup, final.
Long term. It's a brilliant category, very well suited for risk averseness as well as giving the upside in the market. And please make it the core portfolio, whether us or anybody, but as a category. And then build your satellite as per your risk taking ability. Like on the equity side, you build it on the large cap or the multi cap. This is that counterpart on the debt side, and it's poised to be a good sort of run for the next 3-5 years. And some people who are saying that we are a little low interest rate regime, Mr. Jajoo will agree with me. We'll talk after 3 years.
Okay, we will do that. But unfortunately, for now, we'll have to wrap up the show. All three of you, thank you so much for taking the time out and speaking to us on the Mutual Fund Show.
Always a pleasure. Thank you.
Thank you. And
Thank you.
viewers,
Thank you,
thanks for
Niraj.
tuning in to this leg of the Mutual Fund Show.